This is SOSF. Man, you see what's happening out there? It's wild. The whole damn thing is kicking off again. Just when you thought things were maybe, calming down, bam. The president's back on social media threatening a massive increase in tariffs. The market took an absolute bloodbath today. It's insane. It feels like 2018 all over again, but maybe worse. And it got me thinking. We've been here before. We went through this whole crazy cycle. So if we're going to understand what's about to happen, we have to understand what happened last time. This stuff, trade policy, tariffs, supply chains, it sounds so incredibly boring that you'd rather watch paint dry. But I'm telling you, this is the secret architecture of your life. It's the ghost in the machine that decides the price of your iPhone, the security of your 401k, and the kind of world your kids are going to grow up in. The last trade war wasn't just a political pissing match. It was a multi-trillion-dollar bar fight that rearranged the global economy, and you, me, and everyone we know paid the cover charge whether we wanted to or not. I was reading this deep dive analysis on it, some seriously heavy-duty research, and it's wild. It's absolutely wild. These academics, they went through and measured the impact, and the numbers they came back with are staggering. We're not talking about small potatoes here. We're talking about a seismic event that vaporized wealth on a scale that's hard to wrap your head around. So, let's get into it. Let's try to make sense of the chaos, because what went down is a masterclass in how interconnected everything is, and how quickly it can all go sideways. So, how does something like this even start? It's not like someone just wakes up one morning and flips a switch that says, "Start trade war." It's more subtle than that, at least at first. It began with paperwork, with a piece of legislation from the 70s called Section 301 of the Trade Act. It's basically a tool that lets the US government investigate if another country is being unfair in its trade practices, like stealing intellectual property, ripping off the blueprints for our tech. The administration at the time launched a huge investigation, and in March 2018, they came out and said, yep, they're not playing fair. And that, right there, was the legal justification they needed to go it alone, to start throwing punches without a referee from the World Trade Organization or anyone else. The first real punch landed on July 6, 2018. The US slapped a 25% tariff on $34 billion worth of Chinese goods. Now, a tariff is just a fancy word for a tax on imports. So, suddenly, all this stuff coming in got 25% more expensive. And what happened next set the tone for the whole damn conflict. China didn't blink. They didn't file a complaint. The very same day, they turned around and did the exact same thing to us. A 25% tariff on $34 billion of American goods. It was perfect, symmetrical retaliation. Dollar for dollar. It was like a scene out of a movie. We hit them. They hit us back just as hard, instantly. A few weeks later, in August, it happened again. Another $16 billion from our side, another $16 billion from theirs. This is the moment when everyone on Wall Street who had been talking about a trade dispute or tension suddenly shut up and started using the word war. This wasn't a negotiation anymore. This was a brawl. And the fear was that this brawl was going to shatter the global supply chains. Now, supply chain is another one of those boring terms. But think of it like this: your smartphone isn't made in one place. It's a global Frankenstein's monster. The processor might be designed in California, the memory chips made in South Korea, the screen in Japan, and 100 other tiny components from all over the world, and it's all put together in a massive factory in China. For decades, this system worked because it was ruthlessly efficient. It was all about making things for the lowest possible cost. But this trade war took a sledgehammer to that system, and investors started to panic. But the real insanity, the thing that made this different from any trade conflict in history, was how the next moves were announced. It was the era of what people started calling tweet risk. Imagine you're a high-stakes poker player, and you're trying to read the other guy, trying to figure out his strategy. Now imagine that instead of playing his cards, he just stands on the table and screams his next move at random intervals, sometimes bluffing, sometimes not. That's what it was like for the markets. Major, world-altering economic policy shifts were being announced on social media with no warning. There's this one hypothetical day the researchers used as an example, but it's based on real events. Imagine the market's been kinda calm for a bit, and then, bam! A tweet goes out threatening a massive increase in tariffs. The reaction was instantaneous and brutal. The S&P 500, which is like a report card for the 500 biggest companies, sank almost 3%. The Dow Jones dropped nearly 900 points. The tech-heavy Nasdaq got hammered, plunging 3.6%. It was the market's worst day in months, and this wasn't a targeted strike. It was a carpet bomb. On a day like that, something like 6 out of every 7 stocks in the S&P 500 went down. It didn't matter if you were a tech company or you sold tractors. The threat was seen as a risk to the entire system. And you saw this classic flight to safety. Investors yanked their money out of the stock market and piled into U.S. Treasury bonds, which are basically the safest investment on planet Earth. They bought gold, and the VIX, which is officially the CBOE Volatility Index but everyone calls it the fear gauge, it surged 30% in a single day. It was a clear, quantifiable spike in pure, raw panic. The market wasn't just reacting to the potential cost of the tariffs, it was reacting to the death of predictability. No one knew what was coming next, and that uncertainty is poison for the economy. After nearly 2 years of this back and forth, this economic street fight, they finally called a timeout. In January 2020, they signed the Phase 1 deal. It was a big media event, and it did calm things down. It stopped a new round of tariffs from happening and even cut the rate on some existing ones. In return, China promised to buy an extra $200 billion of American stuff over the next 2 years, everything from farm goods to energy. The market breathed a huge sigh of relief. The immediate threat was gone. But here's the thing about that deal. It was more of a political off-ramp than a real solution. When you look at the actual numbers, tracked by these super smart people at the Peterson Institute for International Economics, the promises were never kept. Over the 2 years of the deal, China didn't buy any of the extra $200 billion they promised. In fact, they didn't even get back to buying the same amount they were before the trade war started. They ended up buying only about 62% of what they committed to. So, while the deal was great for stopping the bleeding and ending the scary tweet-driven market drops, it didn't fix any of the underlying problems. The tension was still there, simmering under the surface. So, if this whole thing was an earthquake, who felt the tremors the most? It wasn't a monolithic event that affected everyone equally. It was more like a sniper than a bomb, picking specific targets. And the epicenter, ground zero for the entire disaster, was the U.S. technology sector. The tech industry, especially the guys who make semiconductors, the little brains inside all our electronics, was uniquely vulnerable. It's for those 2 reasons we talked about. First, their supply chains are a tangled mess of global spaghetti. A single chip might cross international borders a dozen times before it ends up in your device. Second, China is not just where they build stuff, it's a massive market where they sell a ton of stuff. So they were facing a brutal double whammy. Their manufacturing process was getting taxed to death, and their access to one of their biggest customer bases was being threatened. You could see it plain as day in the stock market. On days when bad trade news hit, the Nasdaq would always fall harder than the broader S&P 500. And the Philadelphia Semiconductor Index, the SOX, which is the benchmark for chip stocks, it would just get annihilated. There was one day it plunged over 6% after an escalatory announcement. Companies like AMD, Nvidia, Broadcom, their stocks would tumble 7 or 8% in a single session. And it wasn't just tariffs. The other side showed they could play dirty too. They launched an antitrust investigation into the American chipmaker Qualcomm, which had nothing to do with tariffs but had everything to do with leverage. And boom, Qualcomm's stock tanked over 7%. It was this constant two-front war for the tech industry. A tariff war on their supply chain and a regulatory war on their market access. They were well and truly screwed. But if the tech sector was an accidental casualty, the U.S. agriculture sector was the intentional, primary target of retaliation. And the poster child for the whole disaster was the soybean. American farmers are the best in the world at growing soybeans, and for years, our single biggest customer was China. In some years, we sold over half of our entire crop to them. Half. It was an incredibly important relationship. So when the U.S. put tariffs on their goods, what did they do? They went straight for the jugular. They slapped a 25% retaliatory tariff on U.S. soybeans. That tax made our beans so expensive that Chinese buyers stopped buying them overnight. It was like a light switch flipped off. They immediately turned to other suppliers, mainly Brazil and Argentina. And for the American farmer, the result was catastrophic. U.S. soybean exports to China just collapsed. One report described the shipments as being effectively zero at the height of the conflict. This created what was called a bloodbath for American farmers. They had all these soybeans harvested and nowhere to sell them. The price of soybean futures plummeted, falling way below what it even cost to grow them. Farmers were facing losses of $100, $200 per acre. It was a crisis that rippled through the entire heartland. And it didn't just hurt the farmers. It hit the whole agribusiness ecosystem. Big agricultural trading companies like Archer Daniels Midland got hammered. Their earnings fell over 50%, and they blamed it directly on the U.S. trade upheaval. Companies that sell stuff to farmers, like the tractor and equipment giant Deere & Company, had to lower their profit forecasts for the whole year. The farmers were broke, so they weren't buying new tractors. It was a brutal lesson in how targeted retaliation can inflict maximum economic pain. Now, here's where the story gets a real ironic twist. One of the main political goals of the tariffs was supposedly to protect and bring back American manufacturing jobs. That was the sales pitch, right? But for many manufacturing firms, the reality was the exact opposite. Studies from the Federal Reserve itself found that the so-called benefits of being protected from imports were completely wiped out by the rising costs of raw materials and the retaliatory tariffs on their own exports. American manufacturers were caught in a vice. On one side, the tariffs on things like steel, aluminum, and electronic components from China drove up their cost of production. It was more expensive to build their products. On the other side, the retaliatory tariffs made their finished products more expensive to sell in the Chinese market. They got hit coming and going. The Federal Reserve concluded that this was a net drag on the sector. It led to job losses and a drop in output. The shield that was meant to protect them ended up being a ball and chain. But in all this carnage and chaos, a few companies actually came out as winners. It was a small group, but their story is fascinating. These were companies that were perfectly positioned to benefit from the idea of economic decoupling, of the two big economies breaking apart. The best examples were in the rare earth minerals sector. Now, rare earths is a weird name. They're not actually that rare, but they're a group of elements that are absolutely essential for all modern technology. They're in your phone, in lasers, in electric vehicles, in advanced military hardware. And one country pretty much has a global monopoly on processing them. So, when Beijing even hinted that they might restrict the export of these critical minerals as a bargaining chip, it sent a shockwave of panic through Washington and Silicon Valley. Investors immediately started scrambling to find a non-Chinese source. And it turns out, there weren't many. There was one major rare earths facility in the United States, owned by a company called MP Materials. On a single day of trade war fears, as Beijing was making these threats, shares of MP Materials shot up over 11%. Another smaller company, USA Rare Earth, gained 15%. The stock market wasn't rewarding them for making a better product or having a great sales quarter. It was rewarding them for their geopolitical value. They were a safe harbor in a storm. Their soaring stock prices were a market bet on deglobalization. A bet that in this new, scary world, a secure supply chain was suddenly worth a hell of a lot more than a cheap one. This is all fascinating from a 30,000-foot view, but what was it like on the ground? What was it like in the boardrooms of the biggest, most powerful companies in the world? When you go from the broad economy down to the individual companies, you see exactly how this abstract policy stuff translates into real dollars and cents. The earnings calls from these corporate bellwethers, the giant companies that are so big they act as a barometer for the whole economy, give you an unfiltered view from the front lines. Let's start with the biggest of them all, Apple. Apple was the perfect case study for the direct financial pain of the trade war. Their entire business model was built on designing products in the US and manufacturing them at a massive scale in China. They were completely exposed. And to their credit, their leadership was pretty upfront about the cost. On one of their earnings calls with Wall Street analysts, they laid it out in stark terms. Management reported that the company had paid about $800 million in tariff-related costs in a single quarter. 3 months. Almost $1 billion. And they projected that if things didn't change, the cost would climb to $1.1 billion the next quarter. These are not small numbers, even for a company the size of Apple. This was money that came directly off their bottom line. They explicitly said that their gross margin, the profit they make on their products, was shrinking primarily driven by these tariff costs. And the market's reaction was really telling. There were times when Apple would report great earnings, beating all the Wall Street expectations, but their stock would still go down. Why? Because investors were more scared about the future risks of the trade war than they were happy about past performance. Apple's stock became what they called a trade war proxy. Its price would swing up or down based on the latest news out of Washington or Beijing. It showed this crazy disconnect. The company could be running its business perfectly, but its value is being held hostage by geopolitical forces completely outside of its control. Then you've got a company like Boeing. For them, the problem was even more complex and strategic than just the cost of parts. They build these massive, incredibly expensive airplanes. Management tried to calm investors down, saying the direct financial hit from tariffs on imported components was manageable, maybe less than $500 million. But their real fear, their nightmare scenario, was losing access to China as a customer. China is one of an essential, key source of future orders for Boeing. During the trade war, Beijing showed it was more than willing to use that market access as a weapon. The CEO of Boeing confirmed in an interview that they had been forced to redirect brand new airplanes that were supposed to go to Chinese airlines to other customers. Why? Because Beijing simply stopped accepting deliveries. They just said, nope, we're not taking them. This wasn't a tariff. You could call it a non-tariff barrier. It was a political move that inflicted direct harm on Boeing's revenue and messed up their entire production schedule. It highlighted this core asymmetry of the conflict. For a company like Boeing, which has these incredibly long and expensive production cycles, being politically denied access to a key market is way more damaging than just a simple tax on aluminum. The risk to Boeing wasn't just commercial, it was fundamentally political. And finally, let's look at Caterpillar. They're the company that makes all that giant yellow construction and mining equipment you see all over the world. Caterpillar is seen as a global economic bellwether. If companies around the world are buying Caterpillar's machines, it means they're building stuff, new mines, new buildings, new roads. It's a sign of a healthy, growing global economy. So, their experience really reflected the broader economic drag of the conflict. Listening to their earnings calls during that period is like listening to a ship captain describe sailing into a hurricane. Even when they were reporting strong sales and a huge backlog of orders, they had to constantly warn about these massive tariff challenges. They projected what they called a $1.5 billion tariff headwind. A headwind. That's the perfect metaphor for the trade war's effect on the whole economy. You had this powerful economic engine that wanted to move forward, but this external, policy-created force was just blowing right in its face, slowing everything down, making it harder and more expensive to get anywhere. Caterpillar's situation showed that even if the underlying global demand for stuff was strong, the friction and uncertainty created by the trade war were directly eating away at profits and making it impossible to plan for the future. This is where the story expands beyond just stock prices and corporate profits. The trade war generated these powerful macroeconomic ripples, and these are the changes that have fundamentally reshaped the world we live in now. The deepest consequences aren't the tariffs themselves, many of which are still in place, but the long-term, structural shifts in how companies behave, how central banks operate, and how the global economy is wired. The conflict left behind what you could call scar tissue. One of the most damaging effects was the chilling effect it had on corporate investment. This is a bit abstract, but it's maybe the most important part of the whole story. A major study by the National Bureau of Economic Research, the NBER, a serious group of academic heavyweights, quantified this. They concluded that all the pervasive policy uncertainty acted as a direct tax on business investment. Think about it from a CEO's perspective. You're thinking about building a new billion-dollar factory. That's a 10-year bet on the future. But how can you make that bet when you have no idea what the rules are going to be next year, or next month, or even next week? When a single tweak can upend your entire business model? You can't. So you don't build the factory. You wait. You hoard cash. You play it safe. The NBER study found that the tariff chaos would lower the investment growth rate of U.S. companies by a cumulative 1.9 percentage points by the end of 2020. Now, 1.9% might not sound like a huge number, but compounded over the whole economy and over many years, it's massive. It represents a loss of productive capacity, of innovation, of future growth. It's jobs that were never created and technologies that were never developed. It was a tax on the future itself. And that same NBER study is where the big, terrifying headline number comes from. They calculated the total cost to U.S. equity investors. They estimated that the whole trade war, our tariffs and their retaliation, lowered the stock prices of the 3,000 U.S. firms in their sample by 6.0 percentage points. Given the size of these companies, that translated into a staggering $1.7 trillion in lost value. Vanished. Gone. And what's really crucial is how they broke down that loss. They found that a little less than half of it was what they called the differential effect, that is, the specific damage to firms that were directly exposed to China. But a larger portion, over half the damage, came from the common effect of broad, market-wide downturn that hit all firms, whether they had anything to do with China or not. This is a critical finding. It means the uncertainty and the fear generated by the trade war didn't stay contained. It infected the entire market like a virus, depressing the value of everything and making everyone poorer. You'd think in a situation like this, the U.S. Federal Reserve could just ride to the rescue, right? Just lower interest rates, fire up the money printers, and make everything okay. But the Fed was in a terrible spot. Their tools were all wrong for this particular problem. See, the Fed is really good at managing problems of demand. If people and businesses aren't spending enough money, the Fed can cut interest rates to make borrowing cheaper, which encourages everyone to go out and buy stuff. They can stimulate demand. But the trade war wasn't a demand problem. It was an adverse supply shock. The tariffs and the broken supply chains made it harder and more expensive to produce things. Using the Fed's tools to fight a supply problem is like trying to fix a car engine with a hammer. It doesn't work, and you might make things worse. Cutting interest rates can't fix a broken supply chain. It can't untax a shipping container full of parts. If you try to stimulate demand when the economy's ability to produce is damaged, you just risk setting off a nasty wave of inflation without getting any real growth. It's a dangerous stagflationary impulse. The Fed was in the tough position of trying to treat the symptoms, like market volatility and slowing growth, without being able to cure the underlying disease. And this leads to the really long-term, 40,000-foot view question that this whole episode raised. It's about the US dollar itself. For our entire lives, the dollar has been the king of the world. It's the global reserve currency. When there's a crisis anywhere in the world, people sell their own currency and buy US dollars for safety. This gives the US what's called an exorbitant privilege. But an analysis from the Brookings Institution argued that this special status is fundamentally tied to the fact that our markets are deep, stable, and, most importantly, open to trade with the rest of the world. By throwing up tariff walls and creating a protectionist environment, the trade war started to weaken the very foundation of the dollar's dominance. The Brookings model suggested there could be a tipping point, maybe around a 26% tariff rate, where it would actually make sense for other, smaller countries to stop pegging their currencies to the dollar and anchor them to something else, like the euro. Now, we didn't quite get to that point, but the analysis highlights a huge long-term risk. An aggressive, unilateral trade policy, while it might be aimed at protecting domestic jobs, could have the terrifying unintended consequence of eroding a key pillar of American economic power. That would mean higher interest rates for us, capital flowing out of the country, and a drop in the value of U.S. companies over the long run. It's a sobering thought. So, where does that leave us? The most intense, tweet-a-minute phase of the trade war is over, but its ghost still haunts the market. It was a profound, multifaceted, and overwhelmingly negative event. It taught us that the market isn't moved by slow, gradual changes, but by sharp, unpredictable shocks. The uncertainty it created was a massive tax on the U.S. economy, vaporizing that $1.7 trillion in wealth and choking off the investment we needed for future growth. The conflict carved up the American economy, punishing the very industries, like tech and agriculture, that were most plugged into the global system, while offering only tiny, fleeting benefits to a few niche players. The legacy is still with us, and it has probably changed the world for good in a few key ways. First, there's now a permanent geopolitical risk premium baked into the stock market. Investors can no longer just look at a company's balance sheet. They also have to ask, how exposed is this company to political whims? That risk now has a price tag. Second, the game has changed from efficiency to resilience. For 30 years, the mantra for big corporations was just-in-time manufacturing. Make everything as cheap as possible, with no inventory buffers. The trade war exposed how fragile that is. Now, the mantra is just in case. Companies are building redundant supply chains, diversifying away from single points of failure. It's a strategy often called China plus one. It's safer, but it's also more expensive, which might mean structurally higher inflation for all of us. And finally, the underlying tensions that started the whole thing. The competition over technology, intellectual property, national security, they haven't gone away. The potential for future flare-ups is now just a permanent feature of the landscape. In the end, the trade war was an incredibly expensive lesson in the market's vulnerability to political chaos. It showed that in a world as interconnected as ours, trying to build walls can often end up just trapping you inside and doing a lot of self-inflicted damage. For anyone trying to invest their money or run a business today, the big takeaway is that you have to be a student of geopolitics now, because the lines between markets, policy, and international relations have been completely and irrevocably blurred. And that leaves me with a final, massive question to chew on. This whole experience has accelerated a global push towards prioritizing security and resilience over pure economic efficiency. We're seeing a trend towards onshoring and building things at home, creating systems that are less vulnerable to foreign disruption. But this process is inherently less efficient and more expensive, which means a potential long-term drag on growth and innovation, and higher prices for consumers. So, here's the thought experiment. Imagine a future where we have two distinct paths. One path continues the trend of deglobalization, where nations build resilient, self-sufficient, but more isolated and less efficient economies, a world of secure, but perhaps stagnant, techno-fortresses. The other path involves trying to rebuild a more cooperative, hyper-efficient globalized system, knowing full well it carries the risk of the same kinds of disruptions and vulnerabilities we just experienced. If you were in charge, which path would you choose for the next 50 years? And what's the real, hidden price of the safety you think you're buying on that first path? See you next time.